Okay, welcome to our first multi-step scenario in these accounting interview question tutorial videos. What we're going to do here is go back to our original example throughout this accounting course on Apple and assume that they're going to be buying an iPhone factory, financing it with debt, and then that they're going to be paying interest on that debt, having the factories depreciate over time, and then after that, in future years, we're going to assume that the factories have to be written down, their value is lost, and the debt has to be repaid. So we're going to go through a three-step process here. We're going to look at each one of those steps that I just mentioned separately and cover them each in a separate video. So whenever you get an accounting question like this in interviews and the interviewer wants you to walk through a multi-step scenario like this, you always want to break it into individual steps so that you don't get confused, because if you try to tackle everything at once, it gets very, very difficult to track and keep track of, especially if you don't have pen and paper or pencil and paper and you're trying to do everything in your head. So the first step here is what happens when Apple buys factories and they finance the purchase with debt. Now, we've been over elements of this before, raising debt and then purchasing factories. So what I'm going to do on the interview questions here is just get started by entering in some of the numbers, and then we'll walk through the three statements, starting with the income statement, going to the cash flow statement, and then finishing with the balance sheet. Even when you have a multi-step scenario like this, I still recommend going in the order of income statement, cash flow statement, and balance sheet, because actually with multi-step scenarios, it can get even more complex. So it's more important that you go in a logical order here. So if Apple buys a factory, what this really means is that their capital expenditures are going up by 100, and then their long-term debt, we're assuming that they're financing this with long-term debt, is also going up by 100. Keep in mind that this scenario here is at the moment of impact, so to speak. So it's immediately after they buy the factories and have raised the debt. So we're not assuming any interest or depreciation or anything like that at this point in time. So let's go over to the income statement now. No changes to the income statement on anything, because again, this is immediately after the fact, so there's no added depreciation, there's no added interest expense here. On the cash flow statement, no changes to operating activities because neither one of these, raising debt, buying factories, these are not considered operational activities. Under investing activities, capital expenditures has gone up or down, depending on your math, by 100 here. So overall, cash flow from investing falls by 100 because we're spending extra cash on capital expenditures. Financing activities, long-term debt has gone up by 100 here. So there's actually no change in our cash balance because cash flow from financing is up by 100, cash flow from investing is down by 100. So our cash balance does not change. Over on the balance sheet, cash stays the same, property and equipment goes up by 100, and so our total assets here are up by 100. On the liabilities and shareholders' equity side, long-term debt here is up by 100, so our total liabilities are up by 100. Total liabilities and shareholders' equity are up by 100 here, and our assets are also up by 100, so our balance sheet balances. And that's the first step of our model here, with figuring out how Apple buying this factory, financing it with debt, and paying for it in future years, figuring out what's going to happen in the first step here at the moment of impact immediately after they buy the factory and finance it with debt is what we just covered here. So to summarize, nothing changes on the income statement. The cash flow statement, cash balance stays neutral because the added capex spending is offset by the long-term debt. And then on the balance sheet, the PP&E increase is offset by the increase in debt on the other side. Those are the most important points to keep in mind for this question. Coming up in the next video, we're going to look at the second step of this process, which is what happens after a year of owning this factory and paying for it with debt. So we're going to have to take into account depreciation as well as interest expense with that scenario.